Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll discuss the role of cash in your portfolio, why holding too much of it can be counterproductive, and what to consider when you think about putting your savings to work. The baseball player Yogi Berra once said that a nickel ain't worth a dime anymore. With inflation still elevated and short-term interest rates having fallen over the past 2 years, many investors may be feeling exactly that same way. Money market fund assets are near record highs at nearly $8 trillion, which suggests that many investors may be holding more cash than their financial plans actually call for. So let's dig into what that means and why it matters. First, it is important to say that cash serves a real and valuable purpose in any financial plan. There are many legitimate reasons to hold cash, including emergency funds, near-term expenses, a home down payment, tuition payments, and more. The question isn't whether to hold cash, but how much is appropriate given your goals and time horizon. The challenge is that cash can feel deceptively safe, especially during periods of stock market volatility, but holding too much of it comes with real long-term costs that are easy to overlook. As this chart shows, money market fund assets climbed sharply alongside interest rates a few years ago. Higher short-term rates looked attractive at the time, but those rates are not locked in, and they have declined. Investors holding large cash positions are now earning less and likely missed a significant portion of the broader market rally over the past few years. This brings us to one of the most important and often misunderstood points about cash. It is not truly risk-free. While the balance in a savings account doesn't fluctuate the way stocks do, the purchasing power of that cash can still decline. Inflation quietly erodes what your dollars can actually buy. This effect may be small in any given year, but it compounds over time. As this chart illustrates, the inflation-adjusted return on cash has been negative for most of the past 2 decades. Even when cash appeared to be generating some income, inflation was often running ahead of it. With headline inflation currently at 4.2%, real cash yields remain negative today. So, where should investors look instead? Stocks and bonds have traditionally served as the foundation for portfolios because they can generate both long-term growth and income in ways that cash simply cannot. For example, dividend-paying sectors of the stock market, such as real estate, energy, and utilities, currently offer yields above 3%, which is comparable to many short-term cash instruments, but with the added potential for capital appreciation over time. On the bond side, extending maturity can also improve returns meaningfully. The broad U.S. bond market is yielding nearly 4.8%, more than 1.5 times its average since 2009. And unlike cash, bonds can also gain in value in ways that help balance a broader portfolio. The goal is to make sure that your cash serves a specific purpose. For investors who have accumulated excess cash over the past few years, putting it to work thoughtfully in a balanced mix of stocks and bonds remains the most effective way to stay ahead of inflation and build toward long-term financial goals. We hope you found these insights helpful. If you would like to discuss how your cash fits into your financial plan or to think about putting your savings to work, please don't hesitate to reach out. We look forward to speaking with you soon.